Welcome to Mind Over Markets, where trading isn't just about charts, it's about mastering the mindset behind every decision. In today's episode, we're diving deep into the role of patience in trading success, the skill that separates impulsive traders from consistently profitable ones. We'll break this down into 5 powerful parts. First, understanding patience as a core trading skill. Second, applying patience in trade selection and timing. Third, staying patient during active trades. Fourth, navigating losses and drawdowns with discipline. And finally, building long-term success through sustained patience. If you're serious about improving your trading psychology and strengthening your edge, this is an episode you don't want to miss. Stay with us until the end, because patience might just be the missing piece in your trading journey. Patience is often described as a virtue in life, but in trading, it is far more than that. It is not simply a personality trait or a moral quality. It is a practical, trainable skill, one that clearly separates consistent, disciplined traders from emotional, reactive ones. Many people enter the financial markets believing success comes from speed, fast entries, quick exits, constant action, and the ability to always be in the game. Social, media, and trading culture often glorify rapid gains and non-stop activity, but in reality, trading does not reward the fastest participant. It rewards the most patient one. The market moves every second, but not every second offers opportunity. There is a profound difference between movement and meaningful opportunity. Price can fluctuate wildly without providing a clear edge. The patient trader understands this distinction. They know that their job is not to trade frequently, it is to trade well. That often means waiting for the right setup, waiting for confirmation, waiting for alignment between structure, momentum, risk, and reward, waiting for the market to reveal its true intent instead of guessing it. Patience in trading begins with a simple but powerful understanding. The market does not owe you opportunities. It does not care about your financial goals, your daily profit target, or your desire to feel productive. There will be days when nothing aligns with your strategy, days when price drifts sideways without structure, days when volatility is chaotic and unpredictable. On such days, the best trade may be no trade at all. For beginners, this can feel deeply uncomfortable. Sitting in front of charts without taking action may create anxiety. There is a temptation to interpret stillness as missed opportunity. The mind starts whispering, "What if this is the move? Or what if I miss out?" But seasoned traders interpret silence differently. They recognize it as protection. They understand that capital preserved during unclear conditions is capital available when clarity returns. Impatience is costly. It leads traders to force trades that do not meet their criteria. They enter positions because they are bored, because they feel pressure to make something happen, because they saw someone else post profits, or because they want to recover a previous loss quickly. These trades are rarely aligned with a structured plan. They are emotional reactions rather than calculated decisions. Over time, forced trades compound losses. Even small, impulsive mistakes accumulate. More damaging than the financial loss is the psychological erosion that follows. Confidence begins to weaken. Doubt creeps in. The trader starts questioning their system, not realizing that the real issue is not the strategy. It is the lack of patience in executing it. Patience also requires accepting uncertainty. No setup is guaranteed. No strategy wins 100% of the time. Even high-probability trades fail. This reality can be uncomfortable for those seeking certainty. Impatient traders often look for confirmation beyond reason. They hesitate, overanalyze, or jump from one strategy to another in search of perfection. Patient traders take a different approach. They understand that trading is a game of probabilities, not certainties. They know that their edge plays out over a series of trades, not a single outcome. Because of this, they do not rush to recover losses. They do not increase position sizes recklessly to make it back. They trust the process. They trust the math behind their strategy. And most importantly, they trust themselves to follow their rules consistently. Another overlooked dimension of patience is preparation. Waiting does not mean being passive or disengaged. It does not mean laziness. On the contrary, patience is active. It is intentional. It is disciplined readiness. Patient traders use quiet market periods to study charts, backtest strategies, journal previous trades, and review mistakes. They refine their entries, improve their risk management, and strengthen their mindset. Preparation builds confidence, and confidence makes waiting easier. When you know exactly what you are looking for, you are less tempted by distractions. You are less vulnerable to emotional impulses. You are not scanning the market randomly, you are hunting with clarity. When opportunity finally appears, patience allows decisive action. Because the trader has waited, because they have prepared, because the setup meets predefined criteria, execution becomes clean and confident. There is no hesitation, no internal debate, just disciplined action aligned with a plan. Ultimately, patience in trading is about respect. Respect for the market's complexity. Respect for your capital as a limited and valuable resource. Respect for your psychological limits and emotional tendencies. It is recognizing that growth takes time, that mastery requires repetition, and that sustainable success is built slowly. Patience is the quiet force behind discipline. It is the anchor that stabilizes emotions. It transforms trading from chaotic guessing into structured execution. Without patience, even the best strategy collapses under emotional pressure. With patience, even a simple strategy can produce remarkable consistency. In the end, patience is not weakness. It is strength under control. It is confidence without urgency. It is the ability to wait calmly while others rush impulsively. And in the markets, that ability often makes all the difference between short-lived excitement and long-term success. One of the clearest ways patience shows up in trading is in trade selection. This is where discipline becomes visible, measurable, and real. Not every price movement deserves your attention. Not every breakout is genuine. Not every pullback offers a safe entry. The market is full of noise, minor fluctuations, false signals, emotional spikes, and short-lived momentum bursts that look promising for a moment and then disappear just as quickly. Patient traders understand something that many beginners overlook. Quality matters far more than quantity. The markets are in constant motion. Prices tick up and down every second, forming patterns that can tempt the eye and trigger impulsive decisions. For someone new to trading, this constant activity creates the illusion that opportunity is everywhere. It feels as though sitting on the sidelines means falling behind. However, meaningful, high-probability opportunities are relatively rare. Truly clean setups where structure, momentum, volume, and risk align do not appear every hour. Sometimes they do not even appear every day. Accepting this reality can be uncomfortable. Watching price fluctuate without taking action can create restlessness. You may see a candle surge upward and imagine the profits you could be making. You may scroll through social media and see other traders posting winning trades, reinforcing the fear that you are missing out. This internal pressure builds quietly. The mind begins to rationalize marginal setups. This looks close enough. It might break out. I'll just take a small position. But chasing movement often leads to entering trades late, at poor prices, or without full confirmation. When you enter out of urgency rather than clarity, your risk increases. You may buy into resistance, sell into support, or place stops in vulnerable locations. What seemed like opportunity was actually noise. Over time, repeatedly acting on noise erodes both capital and confidence. Patience in timing means waiting for alignment. Alignment is when multiple factors support the same idea. Technical structure supports the direction. The broader trend agrees. Volume confirms participation. Risk to reward makes sense. The entry fits within your plan. This alignment does not happen constantly. It often requires sitting through long stretches of indecision, consolidation, or unclear price action. During those periods, patience feels tested. The market may move in small ranges, triggering false breakouts in both directions. It may trend slightly, but without clean pullbacks. It may appear active yet lack structure. The patient trader resists the urge to manufacture opportunity where none exists. They observe, They analyze, they wait. The reward for waiting is clarity. When a setup is truly valid, it rarely feels forced. There is a sense of order in the price action. The levels are clear. The invalidation point is defined. The patient mindset responds differently. It accepts that missed trades are part of the profession and understands that chasing a move after it has already extended usually leads to worse outcomes. Missing a trade does not damage your account. Forcing a late entry often does. The market will always present new opportunities, but capital lost to impatience is not so easily recovered. By limiting trades to only the highest probability setups, patient traders reduce emotional stress dramatically. Fewer trades mean fewer decisions, fewer emotional swings, and fewer chances for mistakes. Each trade becomes intentional. Every entry is supported by logic rather than impulse. Execution becomes cleaner because the trader is not overwhelmed by constant activity. Patience also sharpens perception. When you are not trying to trade every move, you begin to see the market more objectively. Patterns become clearer. Structure becomes easier to identify. You grow selective in a strategic way instead of reactive in an emotional one. Ultimately, patience transforms trading from constant reaction into deliberate action. Instead of feeling pulled by every candle, you operate from a position of control. You decide when conditions are acceptable. You define what qualifies as a true opportunity. You trade less, but with greater purpose. Over time, this selectivity becomes a competitive advantage. While others exhaust themselves chasing every fluctuation, the patient trader conserves energy, capital, and focus for moments that truly matter. In trading, those moments of clarity supported by discipline and patience are where consistency is built. Once a trade is entered, patience becomes even more critical. Many traders do not fail because of poor entries, but because they cannot manage their emotions while the trade is active. The moment real money is exposed to the market, psychological pressure increases. Watching price move tick by tick can trigger fear, greed, doubt, and second-guessing. Every small fluctuation begins to feel significant. Every pullback feels threatening. Every surge feels like it must be secured immediately. Impatience during active trades often leads to early exits. Traders close positions at the first sign of profit because they are afraid the market will reverse and take those gains away. Locking in a small win provides instant relief and emotional validation. It feels safe. It feels responsible. But over time, consistently cutting winners short while allowing losses to reach their full stop creates a negative imbalance. Even with a decent win rate, this behavior quietly destroys long-term profitability. Successful trading requires allowing winning trades enough space to develop and reach their intended targets. Patience also applies to losses. A well-structured trade may temporarily move against you before working out. Markets rarely move in straight lines. Pullbacks, retests, and short-term volatility are natural parts of price movement. Impatient traders interpret these normal fluctuations as failure. They panic, close positions prematurely, and then experience frustration as price eventually moves in their original direction without them. This cycle damages both confidence and consistency. Patient traders approach losses differently. They accept that every trade carries risk from the moment it is placed. If the setup was valid at entry and risk was defined properly, there is no reason to interfere unless the original conditions change. They respect their stop loss as the predetermined point of invalidation. If price reaches that level, the trade idea was wrong, and they exit without emotional drama. If it does not, they allow the trade the necessary room to breathe. Another major challenge during active trades is resisting the urge to interfere. Constantly adjusting stop losses, moving profit targets closer, adding impulsively to positions, or closing trades without a clear reason often comes from discomfort rather than logic. The need to do something is usually an attempt to reduce anxiety, but frequent interference distorts the original risk-to-reward structure and undermines the edge the trader worked to develop. Patience allows the trade to unfold according to the original plan rather than moment-to-moment emotion. It is important to understand that patience does not mean stubbornness. Blindly holding a position while ignoring new information is not discipline, it is ego. If market conditions shift in a way that objectively invalidates the setup, exiting is a rational and professional decision. The key difference lies in intention. Patient traders act according to predefined rules and evolving market structure. Impatient traders react to discomfort, fear, or temporary noise. Developing patience during execution takes deliberate effort. It requires clear trade plans defined before entry, including precise entry criteria, stop placement, position sizing, and profit targets. It requires journaling trades to identify patterns of emotional interference. It requires reviewing both wins and losses honestly to see where impatience influences decisions. Over time, this self-awareness builds emotional control. Experience also plays a role. The more trades a trader sees play out according to plan, both successful and unsuccessful, the more confidence they gain in allowing outcomes to unfold naturally. They begin to understand that individual trades are simply probabilities playing out within a larger sample size. This perspective reduces the emotional weight placed on any single position. Ultimately, patience during active trades transforms execution quality. Instead of being glued to every tick, the trader monitors conditions calmly and objectively. Instead of reacting to every minor fluctuation, they focus on whether the original thesis remains intact. Instead of chasing emotional relief, they prioritize statistical consistency. When patience governs execution, trading becomes structured rather than stressful. Wins are allowed to grow, losses are controlled, decisions become intentional, and over the long run, this disciplined stability compounds into one of the most powerful advantages a trader can develop. Losses are inevitable in trading. No strategy, no matter how refined, produces a perfect record. Even the most disciplined and consistently profitable traders experience drawdowns. The presence of losses is not a sign of failure. It is a structural feature of probability-based decision-making. The true difference between traders who endure and those who disappear lies in how they respond when losses occur. Patience during losing periods is often the defining factor that determines whether a trader survives long enough to succeed. Impatient traders tend to react emotionally when they encounter a string of losses. Frustration builds quickly. Confidence drops. The natural urge is to fix the discomfort immediately. This often leads to revenge trading, entering new positions impulsively in an attempt to recover what was just lost. Position sizes may increase irrationally. Risk parameters may be ignored. Carefully designed rules suddenly feel restrictive. In extreme cases, traders abandon their strategy altogether after only a small sample of losing trades, convinced that something is fundamentally wrong. These reactions usually intensify the problem. What began as a normal statistical drawdown can quickly evolve into an account-threatening decline. Emotional decisions compound risk. Instead of allowing probabilities to stabilize over time, impatient traders magnify volatility through erratic behavior. The real damage often comes not from the original losses, but from the undisciplined attempts to erase them. Patient traders approach losses differently. They understand that no edge produces wins in a straight line. Variance is unavoidable. A series of losing trades does not automatically invalidate a strategy, particularly if those trades followed predefined rules. Rather than reacting impulsively, patient traders pause. They step back from the screen if necessary. They create emotional distance before making any new decisions. During this pause, they review their trades objectively. They ask structured questions. Was the setup valid according to the plan? Was position sizing appropriate? Were entries and exits executed as designed? They look for execution errors, not emotional scapegoats. If mistakes were made, they address them calmly and adjust behavior. If the trades were executed correctly and simply fell within normal statistical variance, they accept the outcome without dramatizing it. Drawdowns are particularly challenging because they test confidence. After several losses in a row, doubt naturally emerges. It becomes tempting to believe that the strategy is broken or that market conditions have permanently shifted. Impatience pushes traders to make drastic changes, to quickly switching systems, altering timeframes, or abandoning proven methods after only a small sample size. Patience allows traders to zoom out. Instead of focusing on the last 3 or 4 trades, they evaluate performance over a meaningful dataset. They review weeks or months of results. They assess whether the drawdown falls within historical norms. This broader perspective prevents emotional overcorrection and preserves strategic stability. In trading, consistency in approach is often more important than constant optimization. Another critical element of patience during losses is measured recovery. The instinct to make it back quickly is powerful. However, attempting rapid recovery usually leads to overtrading, taking marginal setups, entering without confirmation, or trading simply to feel productive. Activity increases while quality decreases. This cycle drains both capital and emotional resilience. Patient traders shift their focus from recovery to protection. Instead of trying to regain losses immediately, they prioritize capital preservation. They may temporarily reduce position size to lower psychological pressure. They trade fewer setups, concentrating only on the highest quality opportunities. This controlled approach allows confidence to rebuild gradually rather than forcing it through aggressive risk. Patience during difficult periods also strengthens psychological endurance. Each drawdown endured with discipline builds resilience. Traders learn that discomfort is temporary. They begin to separate identity from outcomes. A losing streak no longer feels like a personal failure. It becomes a phase within a long-term process. This emotional stability reduces the likelihood of destructive reactions in future downturns. It is important to recognize that patience does not mean ignoring persistent problems. If a strategy consistently underperforms across a statistically significant sample, thoughtful evaluation and adjustment are necessary. The key difference is timing and intention. Patient traders analyze and adapt from a position of clarity, not from immediate frustration. By remaining patient during losing periods, traders preserve more than their accounts. They protect their decision-making framework. They maintain emotional balance. They reinforce disciplined habits that compound over time. In many ways, how a trader behaves during drawdowns reveals their true level of maturity. Long-term success in trading is not built during winning streaks. It is built in the quiet discipline shown when results temporarily decline. Emotional stability during losses is not just a desirable trait, it is a prerequisite. Patience in adversity allows traders to stay in the game long enough for their edge to play out, and in a profession governed by probability, survival and consistency are the foundations upon which lasting success is built. True trading success is measured over years, not days or weeks. It is not defined by a single winning trade, a strong month, or even an impressive quarter. Real success in the markets is built slowly, through cycles of growth, setbacks, refinement, and persistence. Long-term patience is what allows traders to move through those cycles without losing direction. It creates stability in an environment that constantly tests emotional control. Many people enter trading with unrealistic expectations. They see stories of rapid gains and imagine immediate financial freedom. They believe that with enough motivation or screen time, results will come quickly. But when early outcomes fail to match those expectations, frustration begins to grow. Doubt creeps in. They question their strategy, their ability, or even the viability of trading itself. Patient traders approach the journey differently. They understand that mastery takes time. Just as a doctor, pilot, or engineer requires years of study and practice, a trader must develop skill through repetition and reflection. They treat trading as a profession, not a shortcut. They accept that growth is incremental and that experience cannot be rushed. This long-term perspective changes everything. Instead of obsessing over daily profit and loss, patient traders focus on process. They measure success by how well they followed their plan, how effectively they managed risk, and how honestly they reviewed their mistakes. The outcome of any single trade becomes less important than the consistency of their behavior. Long-term patience also means committing to a proven process. Strategies naturally evolve over time as traders gain insights and adapt to market conditions. However, constantly switching systems out of impatience prevents true mastery. Jumping from one indicator to another, from one style to another, or from one time frame to another creates confusion and inconsistency. Consistency builds familiarity, familiarity builds confidence, and confidence supports disciplined execution. When you stick with a structured approach long enough to gather meaningful data, you begin to understand its strengths and weaknesses. You recognize which conditions favor your edge and which conditions require caution. That depth of understanding cannot be achieved through constant change. There is also profound patience in the concept of compounding. Small, steady gains may feel insignificant at first. A few percentage points each month may not seem dramatic, but over time, compounding transforms modest growth into substantial results. The mathematics of compounding rewards discipline and punishes recklessness. Impatient traders often attempt to accelerate this process. They over-leverage. They increase position sizes beyond their risk tolerance. They chase larger gains in shorter time frames. While this approach may occasionally produce quick profits, it also dramatically increases the likelihood of large drawdowns. Rapid growth fueled by excessive risk is rarely sustainable. Patient traders understand that protecting capital is the foundation of compounding. They prioritize risk management above excitement. They accept gradual growth because they know consistency outperforms bursts of aggression in the long run. They focus on staying in the game. Longevity becomes the goal. Over years, this steady approach produces something far more valuable than profit. Alone it produces emotional stability. When traders are not constantly chasing rapid gains, they experience less stress. They become less reactive to short-term fluctuations. They learn to detach their self-worth from individual outcomes. This perspective shift is powerful. Instead of viewing a losing trade as a personal failure, it becomes feedback. Instead of viewing a winning trade as proof of superiority, it becomes confirmation that the process worked this time. The market transforms from a battlefield of emotions into a classroom of continuous learning. Patience also creates resilience. Markets change, volatility shifts, economic cycles rise and fall. Traders who operate with a long-term mindset adapt more effectively because they are not desperate for immediate results. They have the emotional bandwidth to observe, adjust, and refine without panic. In the end, patience is not passive waiting. It is active discipline. It is emotional control during uncertainty. It is trusting your preparation, your rules, and your long-term vision even when short-term results fluctuate. It is choosing sustainability over speed, structure over impulse, and growth over gratification. Those who cultivate long-term patience give themselves the greatest chance of lasting success in the markets. They understand that trading is not a sprint. It is not even a single marathon. It is a continuous journey of improvement, adaptation, and disciplined execution. If you are serious about building real, sustainable trading success, commit to patience today. Focus on mastering your process. Protect your capital. Track your progress over months and years, not hours and days. Develop the mindset that values consistency over excitement. And if this message resonates with you, take action. Reflect on your current approach. Are you trading for quick validation, or are you building long-term skill? Make the decision to slow down, refine your strategy, and embrace disciplined growth. Stay committed, stay patient, and most importantly, stay in the game long enough to let your edge truly work in your favor. If you're serious about mastering your mindset and building real consistency in the markets, then you're in the right place. At Mind Over Markets, we focus on the psychology, discipline, and strategy that separate emotional traders from confident, consistent ones. If today's message brought you value, don't stop here. Subscribe to the channel, turn on notifications, and become part of a community committed to growth. Share this with a fellow trader who needs to hear it, and drop a comment below with the biggest lesson you took away. Remember, success in trading starts in the mind. Stay disciplined, stay patient, and we'll see you in the next episode of Mind Over Markets.